Hi, Tiffany here. In this video, I'm going to go over 5 key wealth management strategies for Americans living in Canada or moving to Canada. If you'd like to protect your assets when you cross the border, this is for you. Stay to the end to find out the biggest tax trap that Americans living in Canada walk into every single day. It's a common mistake, and if you have a large portfolio, it could cost you hundreds of thousands of dollars. I'm Tiffany Woodfield, a cross-border financial advisor and the co-founder of Swan Wealth Management. I work with US and Canadian clients every day, and over the years, I've seen hundreds of smart people make very costly mistakes. That's why I make these videos. My goal is to help you avoid the biggest mistakes and create a proper plan. So let's get into it. Estate planning in Canada is completely different from the US. There are a few key pitfalls you should know. First, Canada has what's called a deemed disposition at death. This means that when you pass away, it's like all of your assets, including investment accounts and properties, were sold at their fair market value. Your estate's unrealized capital gains from non-registered investment accounts will be subject to tax. And RSP and RIF accounts will be deemed to be fully distributed on the date of your death. For tax purposes, it's as though they were sold. In many cases, more than half of the estate will be lost to the government. This is much different than the US. In the US, your estate will only be taxed on death if it goes over the US lifetime estate tax threshold. Right now, that threshold is $15 million. Next, trusts are treated differently in Canada. You probably don't want to hold a US revocable living trust when you move to Canada, because doing so could lead to double taxation. In addition, where your beneficiaries live matters. If you're trying to make sure that your loved ones get equal amounts, you have to think about taxation. If one of your kids lives in the US and the other lives in Canada, their inheritance might be taxed differently. Some assets are more tax efficient to pass to a Canadian resident, while others are better for a US resident. Let's say your estate is worth $5 million. If that's the case, even a small tax efficiency gap between beneficiaries can mean hundreds of thousands of dollars lost. And if you have more than $10 million, this is potentially a 7-figure problem. I know we just talked about estate planning, but this is so important that it deserves its own section. If you're currently living in the US, you probably have a US executor for your will. After you move to Canada, if your executor lives in the US, the CRA could treat your estate as a foreign trust. That's not good. If your estate gets classified as a foreign trust, your beneficiaries could face double taxation. If you're a Canadian resident, the solution is to have an executor who also lives in Canada. The best option may be to use a corporate independent trustee. Then you don't have to worry about people moving and creating a tax risk all over again. Many people think that moving their investments across the border is what triggers taxation, but that's typically not the case. It's when you move across the border and become a Canadian tax resident that triggers a taxable event. If you're a US person living in Canada, you need to report your income to 2 countries, and you need to do this no matter where your investments are located. So when you receive income or realize capital gains from investments, even if they're in the US, you now need to report to Canada. Taxation is typically based on the country where you're considered a tax resident when you receive your income. People often move and think they'll keep it simple by leaving their investment accounts in the US. But when you do this, you're not minimizing taxes, you're creating complexity. You'll have to report those investments to Canada and you won't have the correct tax receipts, cost base, or currency. Your accountant will need to calculate everything for your tax filings in Canada manually. This is inefficient and will cost you at tax time. And many accountants won't even do it because they're simply too busy at tax time. Also, once you become a non-resident of the US, your US brokerage firm isn't allowed to give you advice or manage your investment accounts. This is according to the SEC regulations. Finally, if your investments are in Canada and the US, Optimizing your portfolio and creating income streams is much more difficult. Basically, it's very inefficient to keep your taxable US accounts in the US after you move to Canada. Once you live in Canada, investing in Canadian dividend-paying stocks can be a great solution if you're looking for tax-efficient income. This is because Canadian dividends are taxed much more favorably than interest income or foreign dividends. For example, let's say you live in BC and receive $100,000 in eligible dividends. For the current tax year, you would pay a little over $3,000 in income tax on those dividends. If that same $100,000 were interest income, you would pay just over $20,000 in tax. That's over 6 times more. Next, we're going to talk about the biggest mistake I see Americans living in Canada make. If you're worried about complexity and overpaying your taxes, you should avoid PFICs. PFIC stands for Passive Foreign Investment Company. In Canada, PFICs are taxed like any other investment, but the US adds its own punishing rules on top of that. When you sell a PFIC, the gain may get spread across every year you held the investment, and interest charges may be added on top. This makes the bill much larger than a regular capital gain. The tax hit can be 3 to 4 times higher than normal. On top of that, you have to file the IRS Form 8621 for every PFIC annually. Cross-border accountants charge anywhere from $200 to over $1,000 per form. So, if you have 15 to 20 PFICs in your portfolio, you could be paying $3,000 to $20,000 every single year just to stay compliant. That's before you pay the tax bill itself. So, what should you do? Keep it simple and avoid buying Canadian mutual funds and ETFs. You can hold individual Canadian stocks. You can use US stocks and US listed ETFs. You can hold Canadian ETFs if they're in your RRSP or IRA account without having to report for the PFICs. When should I create a plan? This is one of the most common questions I get. Most people think they don't need a cross-border advisor until they're ready to move. But that's like training for a marathon the week before race day. You can still do it, but it's way harder than it needs to be. And you probably won't win the race. When you don't have a plan, you're in limbo. You have to deal with uncertainty every time you think about the move. So as soon as you know that you want to move to Canada, start working with a cross-border advisor, even if the move is 2 to 3 years away. From there, you're free to make decisions about when and how to move. Thanks so much for watching, and I'll see you in the next video.